Welcome back. You're still tuned into Trading Hour. It's a full 300-point gain, and we've been holding very steady ever since the market opened. The sensex is now seeing a near 1,000-point rally as well. And you have, all of these indices, including the mid-cap index, which are at a fresh record high today after that big election win by the BJP across states. We have Dhiraj Sachdev joining us now. He's managing partner and CIO at Roha Asset Managers. Dhiraj, thanks a lot for joining us today. Considering that we've got this big, domination by the BJP, this event seems to be, it's gone way better than any of the exit polls even imagined. Do you think that the next 1,500, 2,000 points will be put on very swiftly?
Hi, good morning, Pavithra. So clearly, coming from the state election verdict hangover, we can take a cue for central elections next year. And with earnings support, it is a high probable event that market will sustain this rally even more vigorously before May 2024 election outcome. The continuity of reformist government will be anticipated well in advance by the markets, and along with better earnings growth will be the twin forces that will push markets to higher levels. Broadly, we remain positive given strong capex from government side across core sectors of the economy, like infrastructure, besides thrust on improving manufacturing cycle, which has never happened in the last 4 or 5 decades or so, and also ongoing reforms in the power sector. Rural focus will, like low-cost housing, agri, and provision of drinking water for all, will only gain momentum in times to come. So overall, corporate profits are expected to recover on fall in input costs, energy costs, freight costs, and with better domestic demand conditions. So yes, there are clear signs that even before the election outcome in the month of May next year, the market rally can be even more steep and vigorous.
Steep and vigorous rally ahead. Do you want to put a number to it, Dhiraj? By May of 2024, where do you think the Nifty or the sensex could be?
So, Reema, 10, 15, 20% is highly probable. I mean, that's the least we can expect from now on.
Got it. One leg of a bull run or market upside is driven by earnings increases, EPS increases. And the second leg, in a bull market is when the PE expands. Now, so far, the PE of the overall market is fairly reasonable at 19, 20 times in line with long-term averages. Do you see PE expansion going ahead or in this next 10, 20% rally that you foresee?
Yeah, even so higher valuations will likely to sustain, though we are not in any kind of a crazy valuation yet. But with lower election risk outcome of May 2024, post-recent state election verdict, as well as expected interest rate cuts in US, including domestic central bankers, given the inflation is being stable, we can expect PE expansion along with the markets driven by the earnings growth factor. So as mentioned, there may be pockets of overvaluation where some sectors of the market will be ahead of time in terms of their earnings, and there are spaces which can be preferred. So there are always going to be potential opportunities with sector shift strategy in the market.
Okay, got that. Dhiraj, considering that we are likely to see this kind of big move that you're talking about, how would you position yourself just in terms of the market cap? Do you think that it is better to look at the large caps at a time like this when the Nifty itself is expected to rally so hard, or would you still keep the faith in the broader markets, which has already run up a lot?
Yeah, so it's a very interesting question, and this has been cropping up time and again. So on the small and mid-cap side of the market, if you see, Pavithra, it is unwise to generalize all stocks into one basket, as this category has vast ocean of universal stocks spanning over a few thousand companies, not even talking about 100 companies, but few thousand companies. So one needs to have bottom-up approach to stock picking despite relative volatility or beta being higher than large caps. Of course, if you see in the last 7 months or so, large caps have underperformed in terms of rally or positive returns compared to small and mid caps. Small mid caps, if they have gone 2x versus large cap, which has gone maybe by 1x. So going forward, while the large caps look attractive, the degree of outperformance and performance of small and mid cap will not be as material as in the past 6 to 8 months. But it is not wise to say that small and mid caps will not participate if the large caps are rallying. So I would say that the broader market will in fact rally together, though the degree of outperformance will be limited in the small caps going forward.
Dhiraj, what's the top-down macro call on global equities? Because this year, contrary to all expectations at the beginning of the year, US markets have done pretty well. The US economy is in fine shape. So what's the big call that you have, top down for next year, the next 6 to 12 months?
Clearly, Reema, a lot of people have gone wrong in estimating. People have talked about US recession to interest rates being there at higher levels for too long. And now suddenly we are changing a shift in terms of opinions and views that interest rates have peaked out. There could be even interest rate cuts into the US into the next year. The demand conditions are extremely strong. For example, the textile exports market is suddenly seeing renewed demand pattern. And we have been one of the largest home textile companies in India into the US. So we clearly believe that US is not in any kind of a recession or slowdown. There could be potential risk in terms of lag effect of higher interest rates in US, maybe 3 months down the line, 6 months down the line, that we need to watch out for. But nothing alarming as far as US market is concerned.
Okay, Dhiraj, we'll leave it at that. Thank you very much for joining us with that quick take on the market and some of these individual pockets as well. We do need to get into a short break now, but there's lots more market action lined up for you in just a bit, so stay with us.